On paper, Australia appears to be one of the most successful and wealthiest nations on Earth. For decades, it has boasted an enviable lifestyle, underpinned by a seemingly endless run of economic growth. But behind the headlines of low unemployment and high medium wealth, a different story is unfolding. For millions of ordinary Australians, the national narrative of prosperity feels increasingly like a fiction. This isn't a story of a sudden crisis, but of a slow, systemic erosion of the very foundations that made Australia the lucky country. It's a story about deep, structural flaws in the architecture of the economy, flaws that have been ignored for years but are now becoming impossible to hide. Today, we're not asking if the luck has run out. We're asking, what was that luck built on in the first place? And what happens when the foundations begin to crack? To understand the precarious position Australia finds itself in, you need to understand the three pillars that have supported its economy for the last 2 decades: resources, real estate, and household debt. For a long time, these three pillars reinforced each other, creating a powerful cycle of growth. But today, they represent a chain of vulnerabilities. Let's start with the first pillar, the resource economy. When the global financial crisis hit in 2008, most Western economies buckled. Australia, however, seemed to sail through, thanks almost entirely to China's insatiable demand for its raw materials, especially iron ore. This China-fueled mining boom supercharged the national income and shaped the entire economy. In 2023, China purchased a staggering 84% of Australia's iron ore exports, a commodity that alone accounted for 23% of the nation's total exports. But this boom had a side effect. The flood of money from mining strengthened the Australian dollar, making other parts of the economy, like manufacturing, less competitive on the world stage. Australia didn't just get rich selling resources, it became structurally dependent on them, and on one primary customer. This has left the economy incredibly vulnerable to shifts in Chinese industrial policy and its slowing growth. So, where did all that mining money go? A huge portion of it flowed directly into the second pillar, property. The great Australian dream of home ownership morphed into a national obsession with real estate as an investment vehicle. This wasn't just a simple case of supply and demand. The market has been systematically inflated by a range of factors. On the demand side, generous tax incentives like negative gearing and capital gains tax discounts have encouraged property investment. High population growth, driven by immigration, has also consistently fueled demand for housing. On the supply side, restrictive zoning laws and delays in construction have created a bottleneck, failing to deliver enough housing where it's needed most. For over a decade, this explosive mix was fueled by record low interest rates, which made borrowing vast sums of money cheaper than ever before. The result is one of the most severe housing crises in the nation's history. It's a crisis of affordability that has pushed home ownership out of reach for millions and created immense rental stress. Residential land now accounts for nearly half of Australia's entire national wealth, eclipsing every other asset class. We haven't just built houses, we've built an economy on top of a housing market that many now see as a bubble. This brings us to the third and perhaps most critical pillar, household debt. While property values and corporate profits soared, something else remained stubbornly flat: real wages. For over a decade, the pay packets of average workers failed to keep up with the rising cost of living. Research from the Australia Institute highlights a stark reality. If real wages had kept pace with productivity gains since the year 2000, the average worker would be earning hundreds of dollars more each week. Instead, those productivity benefits have flowed primarily to profits and executives. So how did people cope? They borrowed. To buy a home, to manage bills, to maintain a standard of living, Australians took on debt at an astonishing rate. The house became the national ATM. This has led to Australia having one of the highest household debt-to-income ratios in the developed world. In late 2024, this ratio stood at a near-record high of 182%, meaning households on average owe $1.82 for every dollar of disposable income they earn. This mountain of debt is the economy's Achilles heel. It makes the entire system exquisitely sensitive to the one thing that was kept low for a decade: interest rates. And now the cycle has reversed. To combat post-pandemic inflation, the Reserve Bank of Australia, RBA, has been forced to raise interest rates at the most aggressive pace in a generation. This single action has sent a shockwave through all three pillars of the economy. First, it directly attacks the pillar of household debt. Higher rates mean higher mortgage repayments, stripping cash flow from millions of households. A survey found that these rate hikes have negatively impacted the personal lives and well-being of 75% of Australians with a mortgage, causing heightened stress, anxiety, and mental health strain. Household spending has subsequently fallen, with the savings rate dropping to its lowest level in years. Second, this pressure on households directly threatens the housing market. When borrowers are squeezed and credit is tight, the upward momentum of property prices stalls. While a major crash hasn't occurred, the market is now incredibly vulnerable and the era of easy capital gains is over. And third, this domestic squeeze is happening just as Australia's biggest customer, China, faces its own economic headwinds, including a crisis in its own property sector and slowing growth, creating uncertainty for our resource exports. The interconnectedness that once created a virtuous cycle of growth has now become a vicious feedback loop. Weakness in one pillar now amplifies weakness in the others. So, where does Australia go from here? The nation is at a crossroads, facing a future that will be defined by difficult policy choices, not by luck. Continuing the current path risks a lost decade of economic stagnation. Forging a new path requires confronting uncomfortable truths. Meaningful reform would involve tackling the sacred cows of economic policy. This includes re-examining tax incentives that have prioritized speculative investment in housing over productive business investment. It requires a genuine national effort to boost productivity, not by cutting wages, but through smarter investment in technology, skills and research and development, where Australia lags behind other advanced economies. There is a growing consensus that Australia has a significant productivity problem that has been decades in the making. Crucially, it means diversifying the economy to become less reliant on digging resources out of the ground and selling them to a single geopolitical rival. This involves rebuilding our industrial complexity and finding new markets. None of these solutions are easy. They challenge powerful vested interests and require long-term political vision that extends beyond the next election cycle. The risk is policy paralysis, where leaders are too afraid to act for fear of upsetting the property-owning voter base that has benefited from the old model. The story of the Australian economy is no longer a simple tale of luck. It's a complex, cautionary tale about dependency, debt, and delusion. The foundations laid over the past 20 years have delivered prosperity, but at the cost of resilience. The coming years will be a profound test. Will Australia confront the structural flaws in its economy and begin the painful but necessary process of reinvention, or will it cling to the old pillars, hoping for another boom that may never come while the cracks continue to widen? The choices made now will determine whether Australia can build a more sustainable, equitable, and genuinely prosperous future, or simply manage a long and painful decline. What do you think is the most urgent issue facing the Australian economy? Housing, wages, or our trade dependency? Let us know your thoughts in the comments below. And don't forget to subscribe for more deep dives into the economic challenges shaping our world.